You stare at the chart, wait for the perfect breakout, and buy. Seconds later, the price sharply reverses and hits your stop loss. This happens because institutional market makers pull the strings on retail traders, manufacturing sudden reversals to manipulate the market in their favor. When a price breaks a key level, most retail traders react purely on the fear of missing out. They scramble to enter a position. On the other side of that trade are the market makers, executing a cold strategy to take advantage of that exact panic. These sudden reversals are called fake breakouts or inducements. Institutions engineer them intentionally. They push the price just far enough to trick you into buying, creating the exact liquidity they need to offload their own massive positions. You can spot these traps before they trigger. We are going to build a specific 3-point checklist to filter out fake breakouts. Open your charting software right now. Go to your Indicators tab and add 2 tools, the Stochastic oscillator and a standard volume profile. By applying this filter, you stop serving as the exit liquidity for institutions. You learn exactly what the smart money is doing and position yourself to trade alongside them. To understand why market makers set these traps, let's look at liquidity. Imagine an institution needs to sell 500 crore worth of shares, a massive position. You can't just hit sell on an order that size. To sell 500 crore in shares, the market maker mathematically requires buyers willing to take them at that exact price. This chart shows their solution. The market maker pushes the price to pierce resistance, creating a strong breakout. Retail traders experience FOMO and flood in with buy orders. Once enough buyers enter, the institution unloads their massive sell order directly into that pressure. As the price violently reverses, it hits the stop losses of all those retail buyers. Those stop losses trigger automatic sell orders, which accelerates the downward momentum and pushes the institution's short position straight into profit. This manufactured setup is designed to pull your capital into the market to fill institutional orders. Step 1 of our filter is evaluating the exact behavior of the candle breaking the trend line. The strictest rule in trading breakouts is this: never execute a trade while a breakout candle is still forming. You must wait for the candle to fully close. When you see an unusually large, powerful candle bursting through resistance, be careful. Market makers paint these giant candles specifically to trigger urgency and make you buy immediately. The warning sign appears at the close. Watch for a breakout candle that shrinks downward, leaving a massive upper wick. This marks where initial retail buying pressure was absorbed and overtaken by larger sellers before the candle closed. If you ignore the size of the wicks on your breakout candles, you walk straight into the liquidity trap. Step 2 requires us to look down from the main price chart and check the stochastic indicator. This graph tracks momentum between 2 thresholds, 80 for overbought and 20 for oversold. If price breaks down but stochastic is below 20, do not short. Conversely, if price breaks upward but the line peaks above 80, do not buy. When the price shows an aggressive breakout, but the indicator shows the asset has already maximized its momentum, you have divergence. The price action is an illusion to trick you. By checking the stochastic filter, you stop yourself from buying into a market move that has already exhausted its energy. Step 3 validates the actual physical strength of the move. For this, we look at the volume bars plotted directly beneath the breakout candle. Market makers manipulate the price chart with ease, but when they inject hundreds of millions of dollars into an asset, they leave a massive footprint in the volume data. They cannot hide that execution. This split screen shows the difference. On the left, a breakout accompanied by a massive volume bar proves heavy institutional participation. On the right, an identical breakout has flat volume. This lack of interest increases the likelihood the move will fail. Price movement without volume lacks the necessary conviction to sustain a trend. Using volume as a secondary confirmation helps isolate high-probability setups from low-conviction noise. Let's put all 3 steps together to evaluate a live chart setup. First, we wait for the candle to close and see it leaves a massive upper wick. Second, we check the stochastic and see it is peaking well over the 80 level. Third, we look at the volume beneath the candle and see it is completely flat. The verdict is clear. The criteria scream inducement. The institution is laying a trap, so we stay out and protect our capital. Open up your own charts right now. Go find the last trade you lost on a breakout and run it through this exact checklist. you will likely see exactly where you were trapped. To go deeper into smart money concepts, advanced price action, and technical analysis, check the link in the description for our 30-day trading masterclass. We teach the complete system from basics to advanced. Keep your charts clean and your rules strict, because if you look at the market and cannot identify where the liquidity is coming from, the liquidity is you.